You've seen the headlines, right? A hot new company goes public, and on day one, its stock price either shoots for the moon or just tanks. It's a wild ride that can make or break fortunes in a matter of hours. So, what's really going on behind the scenes? Well, today, we're going to pull back the curtain on the controlled chaos of an IPO.
And that's really the big question, isn't it? How can a price, set so carefully by experts, become so unpredictable the second it's released into the wild? That's exactly what we're here to break down.
Okay, so the first thing you've got to get your head around is this. An initial public offering, or IPO, it isn't the end of a company's journey, not by a long shot. It's the beginning of its life in the public eye. All that private valuation work is done, and now the real race is just getting started.
Now, before any of us can click buy on a single share, there's this super intense behind-the-scenes process to come up with that initial price. And it looks all official and scientific, but honestly, it's really more of a highly educated guess.
The main players in this whole drama, they're called underwriters. Yeah, think of them as the architects of the whole IPO. The company going public hires these big investment banks to, hold their hand through the process, figure out what their shares are worth, and then get them sold to that first wave of investors. And this whole journey, it's definitely a marathon, not a sprint. First, they hire those underwriters we just talked about. Then comes this really crucial stage they call price discovery. After that, you've got mountains of paperwork to file with regulators, and it all leads up to that big day, when the company finally, officially goes public.
So the whole point of all this prep work, all these steps, is to find that perfect sweet spot for the price. It's got to be high enough to make the company a ton of money, right? But it also has to be attractive enough that investors are excited to buy, so every single share gets snapped up. It's a really, really tricky balancing act.
But then, the opening bell rings. The stock starts trading. And poof, that carefully controlled behind-the-scenes world, it just vanishes. The price isn't up to the bankers anymore. Nope. Now, it's up to us, the public.
And this right here is where the rules of the game just completely flip. See, when a company is private, its value is kind of an inside job. It's based on their financial books, what the owners think it's worth, but a public valuation, oh, that is a whole different animal. Now it's driven by the wild, unpredictable forces of supply and demand, the 24/7 news cycle, and just raw public feeling.
Really, if you strip away all the complicated Wall Street jargon, every single one of those crazy price swings boils down to the oldest, simplest rule in economics: supply and demand.
Here's how it works. It's pretty straightforward. On IPO day, there's only a set number of shares to go around, right? So if the hype is massive and everybody wants to buy in, you have tons of demand for a very limited supply. And what happens? The price shoots up. But on the flip side, if some of the early investors decide to cash out and sell, and there just aren't enough new buyers waiting, well, the price goes down. It really is that simple at its core.
Okay, but wait, if it were just about simple supply and demand, it probably wouldn't be this crazy. The real wild card, the X factor in any IPO, is perception. Think about it. Nobody has years of public stock charts to look at for this company. So what are they trading on? They're trading on belief, on hope, on the story. And that perception gets fueled by this whole cocktail of things. You've got the media buzz, right? All these bold predictions about how the company is going to change the world. You mix all that together with some good old-fashioned investor psychology, fear and greed, plus the overall mood of the stock market, and bam, you've got the perfect recipe for some seriously wild price swings.
Okay, I know this all sounds a little abstract, so let's look at a classic, real-world example of what happens when that hype train just completely derails.
Let's hop in the time machine and go back to 2011. Remember Groupon? It was the company everyone was talking about. This idea of getting local daily deals online, people thought it was the next big thing. And the buzz, the hype around its IPO was just deafening.
In the market's excitement, it was completely off the charts. On its very first day, the stock price, when you adjust for splits later on, hit a mind-boggling $524 a share. That wasn't just a price tag, it was a huge statement. Investors were betting that Groupon was the future. But then, well, reality hit hard. The business model turned out to be really tough to keep going, competitors popped up everywhere, and all that initial excitement just evaporated. Fast forward a few years, and that same exact share was trading for about $34. That's a collapse of more than 90%. Just a brutal lesson in the massive gap between opening day hype and long-term business reality. And that's really the core lesson here, isn't it? The actual fundamentals, how healthy the business really is, can get completely buried under a powerful story and a really slick marketing campaign. So, that leads to the big question for anyone thinking about investing. With all this craziness and hype, how on earth are you supposed to navigate these waters? Well, the answer is all about building a solid defense for yourself. And your best defense is just good old-fashioned homework. Due diligence. It means you have to tune out the media noise and just focus on the facts. Companies going public are legally required to file incredibly detailed financial statements. We're talking balance sheets, income statements. You gotta read them. And be super skeptical of those crazy growth charts that just go straight up. Ask yourself, okay, but what's the worst case scenario here? And finally, a really smart move is to compare this new kid on the block to other, more established companies in the same field to see if that price tag even makes sense. So when it all comes down to it, the big takeaway is pretty simple. That initial IPO price, it's not pure science. It's this messy mix of hard numbers and, well, feelings. It's a blend of financial reality and market fantasy. And all that volatility we see on day one, that's just the market trying to figure out in real time which one is actually true. Which kind of leaves us with one last question to chew on. Is that price you see on the news on day one, is that the true value of the company? Or is it really just the price of admission, the ticket to get into a long, loud, and very public argument about what that company is actually worth?